Welcome to Breaking News to Trading Moves. Today we're focusing on the recent Barclays earnings report. What we want to do is map out what those results might imply for specific U.S. financial stocks, really trying to identify who might benefit, and who might be facing some friction.
Exactly. That kind of global read across is so important for you, our listener. Barclays' performance, it really gives us a window into investment banking trends and, crucially, into certain pockets of credit risk. We're going to try and distill that down so you know which names might be worth watching.
Okay, let's start with the headline numbers just quickly. Barclays Q3 pre-tax profit, it was down 7%.
Which sounds negative initially.
Right, but they also launched a pretty hefty buyback program, $500 million, that's about, $670 million? And they guided for their 2025 return on tangible equity, the RoTE, to be above 11%.
Yeah, that RoTE target, that shows some real confidence in their future operations. That's a positive signal for sure.
But that confidence, it wasn't quite across the board, was it?
No, not really. Their investment bank performance was, let's say mixed. We saw good momentum in global markets. FICC, specifically fixed income, currencies, and commodities, that part was strong.
Okay.
But, and this is the key part, the bank itself admitted that its equity capital markets, ECM, and its advisory business.
Yeah.
Well, they lagged behind what we've seen from the top U.S. competitors anyway.
Right. And then there was that specific item that really jumped out, that financial hit tied to Tricolor. Can you tell us more about that charge? Why does it matter so much?
Sure. Barclays booked a $110 million DAT charge linked to Tricolor. And Tricolor was a specialty auto lender, focusing on, subprime auto finance.
Ah, okay.
So this is just about one bad loan. It highlights potential issues in that specific area, valuation risk, loss severity risk, particularly in private credit and auto finance. It's definitely the kind of thing that makes credit investors sit up and take notice.
Okay, so let's use that information. If Barclays is lagging in certain areas, who in the U.S. market might be picking up the slack? Who are the winners here?
Well, the first category that comes to mind is the U.S. bulge-bracket dealmakers.
Yeah.
Barclays' own commentary basically confirmed they're seeing some wallet share pressure. They acknowledge their IB momentum wasn't as strong as the rebound seen by their U.S. peers.
So the overall pie for M&A and ECM might be getting bigger, or at least stabilizing, but Barclays isn't getting its usual slice.
That seems to be the implication.
Suggesting clients are maybe sticking with or moving to the established Wall Street names.
That's a fair assessment. The revenue seems to be concentrating with firms like Goldman Sachs, ticker GS, and Morgan Stanley, ticker MS. These firms just seem better positioned right now for those large, complex deals. Their capital markets operations have that scale.
Execution capability is key there. Okay, what about a second category? You mentioned FICC was strong for Barclays.
Right. That points toward the trading-heavy universal banks in the U.S. The volatility Barclays benefited from in currencies, rates, commodities, that kind of market environment, also tends to boost revenues for the big U.S. banks with large diversified trading desks.
So we're talking about the institutions that can really handle market swings.
Exactly. Primarily JPMorgan Chase, ticker JPM, and Citigroup, ticker C. They have the huge balance sheets, the technology. They're just set up to handle that FICC flow when global markets get active. Trade revenues tend to expand for them in these conditions.
Makes sense. And a third category. If capital markets activity is picking up, even just improving, who else benefits besides the banks doing the deals?
That brings us to the listing and market infrastructure plays. Barclays mentioned investment banking fees improving overall and pointed to ECM activity picking up.
Okay.
When you see more issuance activity, generally more IPOs, more debt deals, it doesn't just help the underwriters. It also supports the companies running the actual exchanges and providing the data infrastructure.
Ah, the platforms where the trading happens. They get a piece of the action regardless of who brings the deal.
Pretty much, yes. Think about NASDAQ, ticker NDAQ, and Intercontinental Exchange, ticker ICE. Higher listing volumes, more trading, more data being consumed. It all feeds into their business models. If GS and MS are busy, NDAQ and ICE tend to see more activity too.
Okay, that covers the potential winners based on the Barclays report. Now we have to look at the other side. Where do Barclays results maybe raise some concerns for U.S. sectors? Let's talk potential losers.
Right. The most direct area flows from that Tricolor charge we discussed. Category 1, subprime and auto credit exposed lenders. That $110 million hit is one part. But Barclays also took a fresh provision related to UK motor finance issues.
So it puts a spotlight back on how risky these auto loans might be and whether U.S. lenders have set aside enough money for potential losses. What was it about Tricolor specifically?
Tricolor was really focused on, well, a specific niche of higher risk auto loans. When a major bank like Barclays takes a direct hit like that, it makes investors question the models used across the specialty finance sector. Are default assumptions too low? Are recovery expectations too high?
And that naturally leads investors to look closely at U.S. firms with significant exposure to similar assets. We're thinking Ally Financial, ticker ALLY, and Capital One Financial, COF, right, given their auto lending books.
That's exactly where attention turns. And that links into the next category, category 2, public business development companies, or BDCs, and the broader private credit space.
Okay, why does a failure in specialty auto lending make people nervous about the whole private debt market? They seem related, but different.
It's about the potential for hidden risks. The Tricolor situation, linked with First Brands, it just raises questions about valuation transparency and potential recovery values in private debt more broadly. Unlike public stocks or bonds, these private loans don't trade every day. So it's possible for credit quality to worsen without it being obvious until something forces a write-down.
And that Tricolor loss kind of confirms fears that maybe recovery values on defaulted private loans could be lower than some models assumed.
That's the concern, yes. If that uncertainty grows, investors might demand a higher risk premium for holding these less transparent assets.
Which puts pressure on the publicly traded vehicles that hold these private loans, the BDCs.
Correct. Major players like Ares Capital, ticker ARCC, and Blackstone Secured Lending, ticker BXSL, their stock prices are sensitive to perceptions about the health and valuation of their underlying private debt portfolios. Doubts about recovery can definitely weigh on them.
Got it. And the final category of potential losers.
Category 3 is the non-FICC-centric brokers. This ties back to that mixed performance in Barclays Investment Bank. Remember, FICC was strong, but equities were relatively softer.
Okay, so if the market environment continues to favor fixed income and currency trading over, say, stock trading, who might lag?
Well, U.S. brokerage firms that rely heavily on things like cash equity commissions or retail trading flows, they might find it harder to keep pace with the big universal banks that are benefiting from that FICC volatility.
Right.
They just don't have that same exposure to fixed income trading revenues.
So firms whose fortunes are more tied to individual investors trading stocks might feel the pressure if the action is elsewhere. Thinking about Charles Schwab, ticker SCHW perhaps, and Robinhood Markets, HOOD.
Exactly. Those types of firms tend to thrive when retail engagement in stocks is high. If market activity is dominated by institutional FICC flows, their primary revenue engines might not fire as strongly.
Okay, so that maps out the landscape based on Barclays' report. Looking ahead now, what are the key signals we should be tracking? What comes next?
Well, first, keep an eye on capital return signaling. Barclays shifted to a quarterly buyback program.
That's a change in frequency, right?
It is, and it sets a potential precedent. Will U.S. banks follow suit with more frequent capital return updates or stick to their usual, maybe annual schedules? It tells you something about management confidence and visibility.
Good point. And we also need to watch that investment bank momentum, especially M&A and ECM.
Definitely. Are U.S. fee pools continuing to grow faster than those of international banks? If yes, that suggests continued share gains for GS and MS. And it likely means sustained activity levels for the exchanges, too, for ND, AQ, and ICE.
Okay, and finally, you flagged this earlier as critical, private credit stress markers.
Absolutely the most important one, I think. That Tricolor loss needs to be watched closely. Was it a one-off? Any more write-downs? Any distressed loan sales or regulatory scrutiny involving specialty lenders, whether in Europe or the U.S., could rapidly increase pressure. Pressure on ALLY, on COF, and on those BDCs like ARCC and BXSL. This is really the key credit area to monitor right now.
That really seems to be the central question hanging over the sector from this report, doesn't it? Whether future write-downs in private credit, especially away from the giant diversified banks, show that Tricolor was just an isolated case, or maybe the first sign that a broader reassessment of value is needed in specialty lending.
That is precisely the question investors need to grapple with when looking at financials in the near term.
Thank you for walking us through that analysis. And just a reminder to everyone listening, this information is not financial advice or buy or sell recommendations. This is purely the opinion of the author.